Hi, everybody. Welcome and thank you for joining us for our self-directed IRA Tuesday class. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So before we get started, got to give you the disclaimer. Everything you're about to see here is for your educational purposes only. It's important when you're working with Quest to understand the role that we're going to play when it comes to your retirement investments. We're here to offer as much education and as many resources as we can to both our clients and investors. But that being said, we cannot endorse any specific investment, and we also can't offer any sort of tax, legal, or investment advice. So a little bit about us, for those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. Right now, we have over $2.7 billion in assets under administration. We have over 100 employees, 34 of which are certified IRA service professionals. So that means that whenever you give us a call, you're going to get a Quest employee who's going to answer the phone and be able to help you out with just about any IRA question you would have. But if you want to take a deeper dive into the more nuanced topics, we have a certified IRA service professional there to take that dive with you. And right now, we have over $400 million in undirected cash sitting in our clients' accounts. Now, that undirected pool of funds is going to be opportunity. Right? Whether you're a current Quest client who's part of that pool or you're an investor who needs funds to make your deal happen, this is where your opportunity lies. But before you go with any investment, before you pursue any investment at all, what's always the first step is going to be to educate yourself, guys. Check out our YouTube channel. Check out the Education Center on our website. We have hundreds of videos going over every possible topic when it comes to both self-directed IRA investments as well as alternative assets in general. Right? We can go over the ins and outs of investing within an IRA. We go over private money lending. We go over syndications and what implications that can have for your IRA. So please leverage the education that we have there, right, to make sure you're as comfortable as you can with the investment you're looking to pursue. Once you've got it nailed down, you've got your investment lined up, know what you want to pursue, well, it's not going to make itself happen. So you've got to check out our networking events, right? Come to the weekly classes like you are today, both Tuesdays and Saturdays, every week at noon. Also, check out our virtual happy hour that's happening on the fourth Wednesday of every month that's just dedicated to networking. But by far our most common networking event is going to be our self-directed IRA socials on the first, second, and third Tuesday of every month. Right, this is going to happen in Houston, Austin, and Dallas, respectively. And this is where really most of the deals are going to be happening. So how it works, for the first 30 minutes starting off at 6:30, you're going to come out. We have allow for networking within the building, just so you get to meet everybody there. At 7 o'clock, we usually have a speaker come out that'll present for roughly 45 minutes. And then after that, we allow for deal pitching. So if you have something lined up and you want to bring it in front of everybody, there will be the time. Also, if you just have funds and you're looking to lend, you can also get that out to everybody. So come check us out. If you've got any questions at all, please reach out to me. Reach out to any of the IRA specialists. We'll be happy to help. I'm super excited about today's class because I think this is something that not too many people know about, and it's very important to understand when it comes to these real estate investments that you're looking to pursue. So today, we have Heather Dreves talking about the pros and cons of real estate funds versus mortgages. So without further ado, Heather, you there?
I am. Thank you for having me. I'm excited to be here.
Absolutely. Yeah, looking forward to this one. And guys, leverage the chat. If you got questions for Heather or IRA specific questions, put them in the chat. We're going to be here answering all the questions that you have. So with that, Heather, the floor is yours.
Yeah, absolutely. Well, first, a huge shout out to Quest. I have to tell you, I have probably over the 20 years in this industry dealt with every custodian out there. And as a lot of people know, there's some very good ones and there's some that have their challenges. But I must say that we thoroughly enjoy working with Quest. I can't tell you how many clients that we work with, and we're much like Quest. We educate people. We don't give financial advice, nor do we give tax advice. But it's always nice to be able to know that we can refer clients over to Quest and our points of contacts at Quest that have really helped our clients, get on their path to financial freedom, get their accounts rolled over, set up new accounts. So it's very comforting to know that when we send clients over their way, that there is a live person on the other end of that phone call. So we appreciate everything Quest has done. So thank you. So yeah, I'm excited to be here today. I think we are a fairly unique operator in the sense that we actually offer investment options through the purchase of notes and also real estate funds. And so that's not typically common out there. And so I get this question a lot. I mean, every single day that I'm on calls with clients, they're asking me, well, should I be investing in notes, or, what is the upside to the notes versus the real estate funds? So when Quest extended the invitation to talk about this, I jumped all over the opportunity because it's near and dear to my heart. We're passionate about it here. And I think that they both are really good opportunities, to deploy capital. But it really just kind of depends on the investor, what they're trying to accomplish and what their appetite looks like. So we're going to dive into this. I do encourage you guys as we go along, if you have questions, put them in the chat box. I'd love to, address all of those. If I feel like it's pertinent at the time that we're going through this presentation, I'll stop and we'll address those. And then if not, I'll definitely hit those questions at the end of the presentation. So thanks again for the opportunity. We'll get started here. So first, we believe that passive investing can be one of the most popular and best ways that you can put your money to work for you. And investing into a mortgage fund and a note has a lot of benefits. One of the things that we talk a lot about within our organization, and for those of you that don't know who we are, we're Secured Investment Corp. And we actually are not only unique that we actually have investment options for the purchase of notes and also in our funds, but we actually help very active real estate investors. So if any of you that are on the presentation are actually buying real estate and utilizing your IRA funds, we actually lend money to people with IRAs. We will do a non-recourse loan. So that's just kind of on a side note. But what we're really going to talk about today is the opportunity to passively invest. And, I believe strongly that investing through funds and mortgage notes is really an opportunity for clients to actually invest in real estate, but through a very hands-off approach. They're investing in very strong, tangible assets, securing their investments. Investing in mortgage notes and also funds can create consistent quarterly and monthly income. So those of you folks that are on the presentation that are really looking for cash flow, maybe you were self-employed at one time and you've sold your business, you're at a retirement age, we deal with a lot of dentists and doctors that have sold their practices. If you're really looking for cash flow and replacing your income, the funds and also the notes can accommodate that. I think it's a great way to diversify your portfolio with high yields. And it's also a opportunity to be fully deployed without having money sitting in your IRAs not working for you. So there's opportunity for that. And obviously, investing in funds and mortgage notes is IRA friendly. So it's a great way for you guys to grow those types of accounts for yourselves and your families, creating generational wealth. So let's talk first. I thought I'd start off talking about notes. I think funds are a pretty common topic of conversation. We're going to hit on those after this, but I thought I'd start with the notes side of things. So I get a lot of people that'll call and, I'm going to buy notes, and they don't really fully understand what exactly that means. So I think it would be great to just take a quick second and talk about that. Essentially, when you are buying a note or a mortgage, and I get people that say, well, I want to buy a note, I don't want to buy a mortgage, or I want to buy a mortgage and I don't want to buy a note, understand that they come together. Essentially, what your note is, it is your promise to pay. So the borrower signs what is called a promissory note, and it is their promise to repay the loan. It's going to clearly identify the principal balance of the loan. It's going to identify the interest rate that the borrower is being charged and that they are expected to pay. It's also going to identify the repayment schedule. So, for example, our notes are interest-only notes, meaning that our borrowers pay interest-only payments every single month. And then they have what's called a balloon due at the time that they pay off the loan. Sometimes that is at maturity. Sometimes that occurs before maturity. But there's several different ways that people can structure a note. So just understand, when you're looking at notes, one of the biggest things, and I think Zach hit on this, is educate yourself and do your due diligence. Know exactly what the terms of that note are. Because I have seen out there mortgage notes where people don't make monthly interest payments, but then all the interest is due when they pay the loan off. So just understand that there are different ways that a note can be actually structured. If you are buying an existing note, so for example, our mortgages and notes are pre-funded. We close the loan first and then we sell it to investors. There should be a transfer of that promissory note into your name. So it may be transferred to Quest Trust Company for benefit of Zach Wilson's IRA. And it's really important that if that is an existing note, that transfer occurs, because that's how you are identified now as the lien holder. So the note is transferred through typically an allonge of the promissory note, and that is transferring all the terms of the note to you. So now my IRA is owed the money from John Smith. So that is really important. The second thing that's really important to understand is there still should be a security interest document that is recorded at the county level. So some states are mortgage states, some are deeds of trust, but essentially either of those types of security instruments will be recorded at the county level. That is how you have an actual lien against that property. That is what gives you the ability to actually foreclose on that property if there is any event of default. But just understand that does need to be recorded. I cannot tell you how many calls I get a year from clients that said, you told me not to chase rate. I got, caught up. I met this guy at a real estate investment company. He promised to repay me. I never made sure that something was recorded. Now he's not paying me. At that point, you have what's called an unsecured note. So, we play in the secured note arena. We only lend to people where we can actually file a lien against the property, because that is the tangible asset that secures our money. So make sure if you're doing this on your own, or if you're working with an operator where you're buying an existing note, make sure that there is a recorded lien and you have clear title and all of those types of things. You have to do your due diligence. But that security instrument, just to reiterate, always accompanies the note. The note is the promise to repay. The security instrument is actually the document that is recorded at the county level that is actually going to put the lien of record on that piece of property. Okay. Important to understand, they need to go together. So when you're talking about notes, I look at it as essentially two different types of notes. There's what they call a performing note, and there's also what they would call a non-performing note. There is great opportunity for rates of return on these types of investments, but it's important to also understand what that actually means. So essentially, a performing note is a note that you are purchasing that is current. So the borrower is current on their payments, their taxes are current, their insurance is current. That's another thing. If you look at the promissory note, you're going to know the clear definition of non-performing or defaulted. So our notes in particular, they have to keep their property taxes current, they have to keep current insurance on it, and their payments must be current, or it is considered non-performing, or they are in default. So when you're looking at buying performing notes, that note needs to be performing according to the promissory note, okay? Typically, when you're buying a performing note, you're going to buy it at par. So that means if I have a promissory note against a property in Texas and the principal balance is $100,000, we're going to sell it for the $100,000. We're not going to take what's called a discount on it. Still good opportunity with that. When you're buying performing notes, you typically have immediate cash flow. So you guys on here that, again, are looking for cash flow as an investment strategy, performing notes are a great opportunity to do that because, again, they are current on their payments. They're making consistent payments, okay? The second type of note that I look at when I'm looking at classifications of notes is a non-performing note. And understand that there's a lot of upside in non-performing notes, but you're typically buying them at a discount. So non-performing means that the borrower is not paying maybe at all, or maybe they're behind on their payments, or maybe they're in default because their property taxes are owed in arrear, or they don't have insurance. Non-performing means they are not current according to their promissory note, okay? Sometimes when you buy those types of non-performing notes, there's big opportunity because you can buy them at a discount. So sometimes people that own notes, whether they're a corporation like ours or they're individuals, are looking to just offload the asset and free up capital. Maybe they need liquidity for something else, but many times you can actually go in and offer pennies on the dollar. So you might have a note that the principal balance is 100,000, and you could go offer them 80 cents on the dollar and buy that for 80,000. Now you have a $20,000 equity position, right? Because they still owe the 100 grand. But the strategy with that is typically you're going to get that loan worked out. So you might go to the borrower and say, hey, I'm now the lien holder. We understand that you're behind on your note. Let's get you current on payments. Maybe you can take the back payments owed and put it to the back of the loan and then start them off fresh. Really what you're trying to do is get it performing again. That way, when they pay you off, or if you sell that $20,000 upside is yours to keep once you sell it or they pay it off. Okay. But again, non-performing, you're not going to typically see immediate cash flow because again, it's not paying and it's not current in comparison to the performing notes where you're going to see immediate cash flow. Those people are current on their payments, they're keeping them up. And they're just two different strategies. So, I mentioned this when we first started, is they're all good opportunities. It really just kind of boils down to your appetite and how risk adverse you are and what you're trying to accomplish. And I tell people this all the time, you almost should write out 4 to 5 things that you're looking to accomplish through this investment. Is it cash flow? Is it, a growth model? Are you wanting to keep your money deployed all the time? Are you okay with not getting cash flow, but you like seeing the bigger upside at the end? So, I think that personally, whether you're looking at buying notes or investing in a fund, you really should sit down and write those things out. If you have a partner, sit down together and really dial in and determine what you're trying to accomplish and how risk adverse you are. And then I think it's easier to back into these types of opportunities. I get a lot of people that I call it analysis paralysis. They're like, oh, I've been talking to 10 funds and I'm looking at all these notes, and they really have never even sat down and decided what they're trying to accomplish. So I think that's really important too. So some of the biggest reasons, and I get people that ask me this all the time, well, why would I buy a note? What is the upside? I think there's a lot of things. I think that a lot of our clients like buying mortgage notes because they're fixed rates of return. As long as the borrower is making their payments, you aren't going to see the returns fluctuate. If you're buying a note and the yield that you are expecting to receive, providing that borrower makes their payments, is 10%, that's what you're going to receive. Funds are a little different because it can fluctuate based on the profit of the fund. A lot of people like it because it's secured by real estate and it's unaffected by the day-to-day volatility of the stock market. It's a tangible asset, right? You can go see it, touch it, feel it. People really like that. People like mortgage notes because they do create cash flow. And it's a great way to diversify your portfolios. And really, it's a way that you guys can invest in real estate without being the landlord or fixing and flipping. You're not dealing with tenants and toilets. Somebody else with boots on the ground is doing that, and you are just the lender. I think there's huge opportunity to earn passive income and additional income. It doesn't just have to be that you're retired and you're looking to replace your regular income or you've sold your business. I have a lot of clients that do this as additional income. They have their 8 to 5 jobs and they have created this nest egg, and a lot of them do it through their IRA accounts and have rolled over 401k accounts. And now they're looking to just create additional income for themselves. So there's nothing that says this has to be for the client that is currently retired or looking to replace their income. It's really nice for everybody. And it's a great opportunity to grow your IRA. Our CEO in particular only buys notes through his IRA. And I asked him one day, I said, why do you do that? And he said, well, if I am buying a note and I'm lending somebody 70% of the value, there's a 30% upside. So if they don't pay, I could potentially foreclose on that property, sell that property, and then all that profit flows back into my IRA. So it's a great way, again, for tax deferment and tax strategies. And that's a way that you can grow your accounts outside of your maximum contributions that you guys can make. So the other thing I like to talk about when I talk about notes, and this is something that I think everybody should be educated on, is not only do you need to know what the promissory note says and what the parameters of the deal are, as far as, what is the loan term, how much is the principal balance, what's the interest rate, you need to understand what kind of a lien you're buying. And a lien is something that refers to a claim by one person on the property of another for payment of debt. So it means that the lien provides you with a security for your investment. So like I mentioned, we record a mortgage or a deed of trust, depending upon the state, and that is recording a lien against the property. What you do need to understand is there's different kinds of liens. There's first liens, there's second liens, there's third liens. And I mean, I've seen title reports with 7 different liens on the property. When you're buying notes, we only originate in a first lien position. It's not to say that there's not opportunity in seconds and thirds, but you need to understand that, because if you are in any other lien other than a first, if that borrower defaults, let's say you're in a second lien, you're going to need to be able to step up, buy that first lien out to ensure your lien. If that first lien holder forecloses, they're going to wipe out your second or third lien, or whatever the case may be, if you are behind that. So it's important to know a lien determines the order of who gets paid in the event of foreclosure. In the event of foreclosure, first lien holders get paid first. If that first lien holder forecloses, they're going to wipe out anything behind that. Mortgages in a first lien have the highest claim, and loans created after the first are considered riskier investments. It's just really important to understand that. And I get a lot of clients that say, well, how will I know what lien I'm in? Look at a title report. We get title insurance on all of our loans that we originate, which transfer over to our note buyers, and that insures our first lien. Okay, so that gets kind of tricky. And I've had clients that said, I made sure the mortgage was recorded, I saw the promissory note, but I didn't pull title. And when I went to foreclose, I realized there were 2 other people in front of me. So again, do your homework, do your education, do your due diligence, understand exactly what you're buying. We here at Secured Investment Corp, we provide our clients with a massive loan pack. We call it a loan package. It's really a due diligence package. It's really everything that we use to underwrite the file, we provide our note buyers with. So they get to see all the borrower's information, their credit, evidence of title insurance, evidence of hazard insurance, an appraisal or a evaluation of some kind. If there's rehab involved, we provide them with a contractor's bid, so it's clearly defined what they're doing to it. So again, I think it circles back to educating yourself. Do your due diligence. Don't be afraid to ask people. If people are asking you to buy a note, ask them those questions. Say, hey, I want to see evidence of title. This is your guys' hard-earned money and your investments and the way that you're going to create wealth for yourself and your family. At least have the courage to ask them for those things. And if they don't want to give that to you, I wouldn't be working with that operator. They need to be very transparent with you guys. So notes sound great, right? Everybody, likes notes, but let's talk about some of the risks in buying notes. And I will tell you, I am very transparent with our clients, and I probably scare more people off from buying notes than I actually sell, because I just want people to understand the risk. There is huge upside to buying notes, but it's so important to know what you're getting into. So what are some of the risks? One, a borrower could default. There's no guarantee that borrowers will continue to make their payments. So you need to be aligning yourself with an operator or a servicing company that can actually help you with those types of defaulted notes in the event that happens. Again, our CEO loves defaulted notes because he sees that as an opportunity to grow his IRA accounts. But you need to have the team behind you to manage those types of events. So you may need to foreclose. We here at Secured Investment Corp help all of our clients through foreclosure process. You can actually get those services provided to you through a lot of servicing companies. We actually do outside servicing for that. The quicker you can jump on a defaulted note and either get it reperforming or start your foreclosure, the better off you are. Lake City Servicing is our servicing company that helps our clients with their defaulted notes. Some of the other risks, the project might take longer than expected. I had a call yesterday from a client that bought a note from me 12 months ago, well, about 10 months ago. And it is set to mature at the end of November. And we have not heard from the borrower, which is fine. They're current on their payments. So that's not an issue. But the question is, what's their plan? They mature at the end of November. So I tell people this because some people think that, well, I bought a 12-month note, they're paying off, right? They just magically pay off. That doesn't always happen. Sometimes the borrowers may take a little longer to get the project done. Maybe they didn't get their refinance done as quickly as they thought. Sometimes they don't sell the property as quick as they thought they would. So a lot of times when we have those situations, those borrowers will come back to our servicing company and say, hey, I'd like to request an extension. That's not a terrible thing either, because then they will pay an extension fee. It's anywhere from 1 point to 3 points, which is another way to juice your guys' yields, grow your accounts. Most clients that buy notes don't mind extending notes if they're good borrowers. If they're paying, better off for them, because now their money's fully deployed and they don't have to find a new home for it, right? That is also the downside to notes, is you're going to get paid off eventually. That's the whole goal. So then you have to find a new home for your money, which means your money is sent, for example, back to Quest. You're going to work with a team, try to find a new investment opportunity, and then redeploy it. So there can be some downtime with notes when you start getting paid off. We work really closely with our clients, so they always know when they're going to get a payoff, and we'll start shopping, ahead of time for them, so that we can get their money deployed as quick as possible. But just know, if you don't find a deal, you may have undeployed capital. I wouldn't consider that a risk. It's more of a downside to it. And then, let's talk about foreclosure. There are times that you might get a property back through foreclosure and it has tenants in it. You might have to evict them. You could get it back and it's distressed and you have to spend some money to clean it up and sell it. But then the other side of that is the upside, is you could get a cash flowing property back. I've had clients foreclose and there's a tenant in it and they just keep it as a rental. So again, you really need to sit down. You got to look at what you're trying to accomplish, how risk adverse you are. I will tell you, most of my note buyers like to buy notes in their backyard. So if they're out of Dallas, Texas, they love deals out of Dallas. If they're out of Florida, they're going to buy deals out of Florida, because they can go see them, touch them, feel them, manage them. And then the other types of clients that will buy them outside of the states that they're actually located in usually have a team. They have an attorney on call that will do foreclosures. They're very active note buyers. They know contractors in multiple areas. So really just sit down again, put your 3 to 5 things together of what you're trying to accomplish and how risk adverse you are, and you can kind of back into that deal. Okay, makes sense? So I like to show this because a lot of people want to know, well, what is the process? What does it look like to buy a note? So really, you really have to identify the deal, right? Identify the deal. The next most important thing is do your due diligence. Ask for everything. Ask to see all documentation. Ask to see the closing docs if it's a existing note. Obviously, if it's not an existing note and you are going to be the original lender on it, ask to see the operator's due diligence on the borrower. They should give that to you. Once you do your due diligence, you are going to make a decision to invest. If you are using a Quest account, obviously Quest has their direction of investment forms. We actually help our clients fill that out. But if you're doing that yourself, you're going to fill that form out. You're going to need to provide evidence of the promissory note and the mortgage. And then if you are using Quest account, they will transfer the funds to the lender. And then after that, the account is set up with some type of a servicing company. Again, we use Lake City Servicing. They do outside servicing. Any of you guys on here that are actually buying existing notes and trying to service them yourselves, it's a lot of work. We charge $25 a month. Let us know if you're interested in that service. But essentially, your account is set up with servicing. That way, that servicing company can report your earnings accordingly. They can report the interest payments that are paid by the borrowers. They're also going to manage when that borrower wants to pay off. They're going to provide a payoff quote for that borrower to make sure everything that is owed, if there's any additional charges, is accounted for on that. And then, like I said, a lot of times most servicing companies will also do foreclosure management. And then once the project's complete and the borrower refinances or sells the property, they're going to pay you off. And then the cycle starts again. So it's really easy. I would tell you the bulk of the time that you're going to spend is really identifying the deal and doing your due diligence. And in my opinion, that is the most important. Second most important, have it serviced somewhere, regardless of whether it's Lake City or not. Have somebody else collect payments and disperse payments and do collection calls. You do not want to have to do that. Okay. All right. We're going to talk about the funds next. And I think one of the things to probably clarify about our funds is the notes that we sell are the notes out of our fund. So they're essentially the same types of assets. It's just that in the funds, you're going into a pool with other investors in comparison to buying a one-off note where you are the only lender on it. So you have a little bit more control that way, but we'll talk a little bit more about that. So a fund is an investment pool of capital that's been aggregated on behalf of multiple investors. A real estate investment fund is generally spearheaded by a sponsor or an operator who has years, if not decades, of experience in the real estate industry. The fund manager will carefully analyze all individual opportunities, and then these opportunities are executed on using capital that the fund has raised and collected. And I must tell you, not only are you working, with a operator or a sponsor, but we have a massive team behind us. We have 100 employees here. I mean, we have everything from an acquisition team that finds us the opportunities to a loan origination team to legal. So really know who you're working with. And I tell people this all the time. If you are looking at investing in a fund, please do yourself a favor and do your due diligence on the operator. The assets are one thing, but I really believe that being partnered with a good operator that is compliant and doing the things that they should be is so important. There are third-party services out there where you can actually do your due diligence on operators. Veravest is one of them. Do yourself a favor, do your due diligence. Make sure you know exactly who you're investing with, because in my opinion, the experience and the team behind that operator is almost more important than the actual assets. You want to make sure that they are acting in good faith, they are experienced, they have a good track record. So make sure that you're looking into that. Typical types of funds that you see in a real estate fund is a Reg D 506C fund, which we actually have. This requires all of its investors to be what we would call accredited investors, and then a Regulation A plus fund. And this is actually interesting. A Reg A plus fund is a fund that we actually have. And really what it does is it allows anyone to invest. So in the past, most real estate funds always required you to be an accredited investor. So you had to have $1 million in assets, excluding your primary residence, or you had to have $200,000 a year for the past 2 consecutive years as an individual, or $300,000 as a married couple. That is what the Securities and Exchange, it's not our rule. That is what they define as what they would call an accredited investor. That was the way that it was for a long time. Our 506C fund was opened up 10 years ago. And at that time, that was the only way we could open a fund. And so we jumped all over the opportunity about 4 years ago to open up what's called a Regulation A plus fund. So the SEC changed some of their rulings and said, okay, now you guys can allow unaccredited investors into this type of an investment, but we're going to limit how much they can invest. And in all honesty, the SEC is just looking out for the consumer. It's a good thing. But as an operator, it really limited us. Not everybody is an accredited investor. So when those rulings changed about 4 years ago, we as an organization decided we had a big passion for this. We always believe that everybody should be able to create wealth for themselves, regardless of their accredited status. And so we actually have what we call the Circle of Wealth Fund 3. It's our Regulation A fund, and it's got a minimum of $1,000. So again, really great way to deploy capital in a little bit more diversified environment. So let's talk about the benefits of investing in a fund. Steady cash flow. So, you, instead of purchasing one note that in the event that that borrower stops paying, your cash flow is affected, you could potentially put money in a fund where your investment is spread over hundreds of assets. And so cash flow is not as affected when you have one borrower that is in default and not paying. It also provides the ability to generate wealth. The other really great thing about at least our funds, and most funds are this way, is you can actually reinvest your earnings. So those of you folks on here that are saying, hey, I like the notes, but I don't love the fact that I'm going to get paid off every 12 months. And then I got to find another home. I'm busy. I've got my business. I'm a professional. I don't want to deal with that. The opportunity to actually reinvest your earnings. So for those of you that are in growth mode are saying, hey, I'm not trying to supplement my income. I'm not ready to retire yet. I've got plenty of cash flow, but I'd really like to grow my Quest account. You can actually take your earnings that you would receive from the funds and you can reinvest them into your equity as they're paid out. So they're either paid out monthly or quarterly. And it's a great way to compound your earnings. Now you're, actually taking your earnings, putting it into your equity balance, and you're just redeploying that capital. So your money is always out there working for you. Profitability. So big benefit to this is most funds pay what's called a preferred or a hurdle rate, which really means that you get paid first. And quite honestly, you should be paid first. That is how you keep an operator on track to continue to make that fund profitable, is when their upside is paid after the fund members are paid. So ours are set up with what we call preferred rates, meaning we have to hit those preferred rates first. And then there's a 50-50 split on the profit side above and beyond our preferred rates. So great way to ensure that a fund operator is striving to get the highest yields that they can because they're not paid first, and a great way for you to sleep at night knowing, hey, I'm going to get the first, set of preferred rates, and once that's hit or that hurdle is hit, then the operator I'm investing with will be paid. There's tax advantages. Obviously, if you guys are savvy enough to be investing with your Quest accounts, you guys know the advantages to that. I believe there's better diversification. I talk with a lot of clients that say, hey, I've got 50 grand. I want to get this money working for me. I'm looking at buying this note for $50,000 and I'm trying to weigh the opportunities to actually put it in the fund. You, like I said, could take that 50,000 and you definitely could buy a note that, at least with us, is no more than 70% of the value. We vet the borrowers, very, very much, but it's also not a guarantee that they continue to pay. I can guarantee you that you have a lien against that property and there's huge upside in the equity position. But for you guys that are looking for, cash flow and would prefer to be a little more diversified, you could take that 50,000, put it in a fund, and there may be 400 notes in that fund. Okay. So again, that's going to help you accomplish your diversification needs. It also is going to help you accomplish passive income. So again, you guys are looking for cash flow. Our funds pay out monthly or quarterly. So that is very consistent. We pay out all profit, but you need to look at the fund because not all funds do that. Some will just pay a preferred and then they don't share in any profit till the fund winds down. Those are more syndication type of things where you see a lot of upside when they sell the property. Ours is a pretty quick cash flowing fund. So we do pay out all of our profit every quarter. There's no catch up at the end of the year. So just know when you're looking at funds, how do they pay? When do I get paid? How are you getting paid? What is the split on the profit? Those are important things to ask operators, definitely. There's also ability to leverage funds, and I won't get too far in the weeds with this. We don't leverage our funds currently, but some people do leverage their funds, which is really a way to juice their yields. They could go borrow money against the assets of the fund. Right now, who knows what that rate is, but in the past, maybe 3 to 4%. But if they can deploy it at 10, there's still a 6% arbitrage, right? they have protection against inflation. Again, real estate funds, it's real estate assets that are all in there. I definitely think that is a way to hedge against inflation, and it's very hands off. You let the operator that's the expert do the work. You don't need to be out trying to fix and flip properties. I've actually fixed and flipped properties. It's really not that glamorous. I also own rentals. That is also not that glamorous. So this is a way for you guys to invest in a fund environment with a good operator, and do your due diligence on that operator and be very hands off. You don't have to be in there doing the day-to-day investing in real estate. You can still reap the benefits of it without having to be hands on. We talked about diversification. This is going to help lower your portfolio volatility. It allows an investor a better chance to weather all types of markets. Investors, you should always consider your own time horizons, risk appetite, liquidity, financial needs, and goals. I have a lot of clients that do both. I have clients that put money in the fund and then have their money set aside that they are actively looking for notes. And I think that really also depends on what kind of funds you're using. Are you using, qualified funds like with Quest, or are these liquid funds that you're doing out of your savings account? So really look at that. So, like I said, you put your list together of things that you're looking to accomplish and what your risk appetite is. Also identify what types of funds you're looking to invest in. I think that will also help all you guys identify opportunities and not be so overwhelmed with everything. So how much do you need to start investing? Well, this is interesting because in the past, remember I said that most funds you had to be an accredited investor. Our accredited investor fund has a $50,000 minimum, but there are funds out there like ours with very small barriers of entry. So our unaccredited investor fund has a $1,000 buy-in. We actually just helped a client. I love this story. So one of our clients came to us. Him and his wife both have Quest accounts. They are accredited investors, and then they have a little bit of cash they were looking to deploy. So we helped get their IRAs working for them. They also invested a little bit of their personal funds, but he actually started asking about his daughter. And he said, hey, I've got this daughter. She's 18 years old. She just set up an IRA account with Quest. And she doesn't have a ton of money in it. She's got about $5,000. I haven't really found a lot of options out there for her to deploy it. So we actually were able to help her get her money working for her in the same type of environment that her parents did through our unaccredited investor fund. So there's options out there. You just got to look for them. And your Regulation A or your crowdfunding platforms are a good opportunity to do that. So one of the things a lot of my clients will ask me is, okay, well, if I'm buying a note, I can look at my servicing platform that I can log into, and I can see if a borrower is making their payments. It's easy for me to track my investment. I know how much I'm getting. How do I know with a fund how to track my investment? So this is one of the things when you guys are interviewing fund operators out there that you should be asking them is, what does your reporting look like? How often do you report? What kind of reporting will I get? We, for example, report on a quarterly basis, a pretty detailed report. And like I said, our earnings are paid out monthly and also quarterly. But it's important to know so that you can set your expectations. A lot of times, most fund operators will have an online platform that you can log into that you can actually see your earnings, especially for you clients that are reinvesting. I think that's that's harder to track. If you're getting your earnings paid out, you're getting your mailbox money, right? You're getting your checks or your ACH deposited. It's easy to see that. If you're reinvesting earnings, I have a lot of clients that'll say, well, I want to reinvest, but I really want to know how I'm going to track that. Make sure that you're asking them, that operator or that sponsor, what is the transparency? How will I see this? How do you guys report? We, for example, send out a quarterly report. Like I said, we have online access to their account so they can see if they are reinvesting. They can log into their account at the end of the quarter and they can see their dollars that were reinvested into their equity balance, and it'll be identified there. And even for people that receive ACHs and checks, they can actually log in and see that those earnings were paid out. But it's really important for you guys to know what that operator does, because I've heard of funds out there that don't report for a year. That makes me a little nervous. I would personally, if it was my investment, want to know on a regular basis what's going on with the fund. Again, we do it quarterly, so we let our clients know these are the properties we bought. These are all the loans that we originated. We provide them with a profit and loss page so they know exactly what the expenses of the funds were. They know exactly what the profits were that came into the fund for that quarter. And then our fund reporting is actually unique too, because we have our track record on there. I love that. I give that fund report out to a lot of clients that I'm talking to that are just looking and starting their due diligence process. But I want to know, if it was me and I was interviewing an operator and they're telling me, hey, this is what we're going to do, we've got all this going on, I want to know what their track record looks like, because I think that's a telltale sign if they're a good operator. So if that is not included in some type of reporting, I would always ask for that. What's your track record look like? Can I see evidence of that? Most of these funds are audited funds. Ours are. So you can ask to see audited financials also. All right. Potential downsides of real estate funds. You can be taxed on your dividends. Obviously, if you guys are investing with your qualified accounts, that's not a concern. But for example, our clients that are investing outside of like self-directed IRAs and 401ks and things of that nature, they do get a K-1 at the end of the year because ours are set up as a LLC entity. There can be potential high fees and risks. So again, know your operator, know exactly what they charge. Most operators charge a management fee and they share in the profit. So understand what that looks like. The other downside is there could be tie-up periods. So I would tell you that if you are buying notes and comparing that with investing in the fund, sometimes your notes are a little more liquid. It's no guarantee that they pay off at that 12-month mark. But you could potentially sell that note if you needed to get liquid, where your funds are going to have a tie-up period. Our funds in particular have a 12-month tie-up period, which is actually pretty short. I've heard of other funds and syndications that have a 5-year tie-up period. So again, when you write that list down, that's something else I would look at is, how liquid do you need these? When do you need access to this? Because again, that will help you as you guys start doing your due diligence on these types of opportunities. You can quickly say, nope, this has a 5-year tie-up period. I need access to this in 2 years. So again, really dialing in and narrowing down what you're trying to accomplish and some of those other things will help you when you're doing your due diligence, because if you start and you don't have any idea of what you're looking for and what you're trying to accomplish, you're going to be very overwhelmed with information. So again, one of the downsides can be your tie-up periods with funds. And then I think a huge one is working with a bad operator. I mean, I wish I didn't hear this as often as I do. I get calls all the time. I should have just invested with you guys. Why didn't I do my due diligence? Please understand and do your due diligence on who you're doing business with. There are some amazing fund operators out there, and there's some really bad ones. So make sure that you know who you're working with. And then one of the things that comes up often is UBIT, which is your unrelated business income tax. With a fund, that typically only occurs if they are leveraging that fund. There are some other instances. So one of the things I would ask your operator, if you are looking to invest with a fund, is if it could create UBIT. UBIT is not a terrible thing. I think it's gotten a really bad rap out there. But UBIT typically occurs when your fund's being very profitable and also if it's been leveraged. So for you folks that have your IRA accounts and your other self-directed accounts, it's a question you should ask so that you can plan accordingly. It's not a bad thing, and it doesn't mean you shouldn't put money with an operator that potentially could create UBIT, but it's important for you to know so that you guys can plan and leave enough money in your guys' accounts to address that. Okay. All right. Well, I went over a lot. I feel like I just kind of vomited information on you guys. I mean, I really hope that this helped enlighten you guys on some of the pros and cons of each of these types of investment opportunities, mortgage notes versus the funds. I actually have a book, a very small book that I wrote really about alternative investing. And if you guys are interested in it, go to that link, which is securedinvestmentcorp.com/money multiplied. And if you schedule just a 15-minute consultation with us, we'll send you out the book. I'd love to share that with you guys. I know that some of you folks on here are probably very sophisticated and have already been doing a lot of investing yourself. So hopefully you took some nuggets out of this. And for those of you folks that are really new to this, hopefully this kind of gives you somewhere to start. I really think that sitting down and spending half hour to an hour and writing out, some of the things that you guys are looking to accomplish and some of the other identifying factors would really help you guys, because I get calls all the time of people that are just really overwhelmed. So, do yourself a favor and do that. And again, if you want the book, you're welcome to go to the website. You're always welcome to give us a call at our office at 800-898-2717, or you can visit our website at securedinvestmentcorp.com. We'd love to talk with you guys. Honestly, I would tell you probably 70% of our clients that use IRAs are Quest accounts. So we're very familiar with the Quest processes. But we'd love to talk and educate people about what we do, and educate you so that you're prepared when you go out there and start looking at different investment options, that you're better prepared. So if you guys have any questions, I encourage you to put those in now. I don't see a lot. Do you see anything on there, Zach?
No, I'm not seeing anything so far. But really informative. I paid attention. So a lot of these, just a little bit of insight on the back end, I'll have it up and I'll be doing my own work. That one I was tuned in the entire time. You had me hooked on that one. So when you were talking about taking our clients, taking their accounts and kind of just having them redeployed, right? The returns just redeployed back into there. When it's working with an IRA, is there any updated documentation that they would need, or is it really just they can put the funds away, have it sitting there with you, and only pull it out after that?
That's a really good question. So I know that most IRA custodians require a fair market valuation form at the end of the year. And so what we do for those clients is we fill that out for them. So there's no additional documentation unless they added additional funds. We get people that put 50 grand in, and in 6 months are like, we love this, we want to put more money in. They would sign another subscription agreement and operating agreement. But those earnings that are rolled back in, they don't have to do anything else. And then, like I said, my team will actually do their fair market valuation form for them at the end of the year, so that Quest is notified of what their account value is. It's really easy and people love it. I mean, that if I was to tell you the biggest downside I hear about buying notes outside of the potential foreclosures, it is the fact that they have undeployed capital, and they have to find a home for it. And even small dollars, if you fund a $100,000 note, you're getting paid 10%, you're getting about $1,000 a month, maybe a little bit less than that. So then they have this $1,000 a month sitting back in their Quest account. They don't have enough to put it anywhere else. So that is one of the biggest downsides I hear often from people that buy notes from us, is especially if they're using IRA funds. If it's personal funds, that's totally different. But I hear that it's common.
Exactly. And because these accounts aren't interest bearing, that cash is just going to kind of sit there like a rock. So I can definitely see why, as an IRA investor, that I would just want my funds redeployed, right? Let's have them working. Let's get them back in there. And then down the road, if I decide I want to pull out and go with another investment or whatever it is, or if I need to start taking distributions, at that time, I can start pulling them out and get them out of the fund.
Yeah, absolutely. I actually have one gentleman that he buys notes from me, and he takes his earnings every month and then reinvests it into the fund. So that is one way you could keep it deployed. It's a lot of paperwork, but I think it's genius. It's like, I would totally do that too.
All right. So, he's got his system working. Why not? Right.
Yeah.
All right, Heather. Well, it looks like there aren't any questions in there. Guys, if you have any questions for Heather, you've got the phone number right there. Reach out to Secured Investment Corp. I know they'd be happy to help you out. And like she said, a lot of our clients are Quest clients. And so if you're one of our clients, reach out to her, if this is something you're interested in pursuing. And obviously, if you got IRA questions, give us a call here. Any one of our IRA specialists will be happy to help you out. But Heather, thank you so much for coming out and presenting for us.
Yeah, absolutely. It was my honor. I love sharing and educating. And I joke that I went to college to be a teacher and decided I really didn't want to deal with children all day. And
Mhm.
someone said, "But you are an educator." I said, "I never really thought of it that way. But, I have a passion for this. I've seen how powerful it is, especially using these qualified accounts. And I've seen, people change their lives and be able to enjoy their families and create generational wealth. So I'd love to share if anybody has additional questions.
Absolutely. Thank you so much for coming out again, Heather. And you guys have a good week.